concept is given a name as forward rate agreement. It is given a name as FRA. Let us have understanding of this new concept. Now to explain this concept, I am just giving you a connection with one of the point like this. Suppose there is an Indian company called Reliance Industries Limited. Let us say that this company has exported goods. On 1st of January, and on export of the goods, this company is going to receive consideration after 3 months on 31st of March. The consideration is going to be received, let us say that in dollar currency. The Reliance company is going to receive an amount of $1,000 after 3 months. We know that the exchange rate between rupee currency and dollar currency keeps on fluctuating. So, after 3 months, whatever the consideration that the Reliance company is going to receive, what will be its value in rupee currency, for that there is an uncertainty on 1st of January. So, whatever this risk, the risk of the exchange rate fluctuation, whatever the risk which the Reliance company is having, say it can be hedged. You can eliminate the risk from this exchange rate fluctuation by entering into a contract which is given a name as forward contract. Let us assume that the forward contract is entered upon at forward exchange rate of 75 rupees per dollar. Let us assume that, so this is the forward exchange rate which is prevailing on 1st of January for 31st of March for conversion of the dollar into rupees. And this forward contract is entered upon. Then what will happen, friends? On 31st of March, suppose the spot exchange rate is 73 rupees per dollar. Even in that case, so the Reliance company will receive 75 only. Suppose the spot exchange rate is 70 rupees per dollar. Even in that case, the Reliance company will receive rupees 75 only. Whatever the forward exchange rate which has been committed by the bank to the company, that itself is the rate at which the conversion will take place. Now, at the same time, if at all the spot exchange rate is 77 rupees per dollar, even in that case you are going to receive an amount of rupees 75 only. If at all the spot exchange rate is more or less, in either of the case you will receive a fixed amount, that is 75. And this is given a technical name as you have entered into the forward contract for the purpose of hedging. There are a number of other contracts which are also available, but say this is what one of the contract which is there, that is called forward contract. Now whatever the concept that we understand with respect to the conversion of one currency into another, exactly the same concept is here with respect to the forward rate agreement. Then basically over here, what happens that say this kind of contract is entered upon if at all in future you are going to make investment of the funds, or you are going to borrow funds. In both the cases, so the contract is entered upon. If at all you are going to make investment in future, or you are going to say having the borrowing of the funds. Of course, we understand that if at all you are going to make investment in future, let us say that the today's date is 1st of January, and you are going to make investment on 1st of April. And by the time this 3 months you are expecting the rate of interest to fall down. Then in that case, say you would like to enter into the forward rate agreement. At the same time, we understand like this. If at all after a period of the 3 months, you are going to borrow and you are expecting that so the rate of interest is going to rise. Even in that case, you can enter into the transaction of the forward rate agreement. In short, forward rate agreement is a contract which is entered upon for the purpose of hedging your transaction of the investment or the transaction of the borrowing. This is what we understand. How the forward rate agreement, so the transaction will be entered upon and say how its execution will be made, that is now what we are going to discuss. Now let us take some examples like this. Let us say that there is a person called Mr. A. Listen carefully. On 1st of January, Mr. A is considering something like this, that after 3 months, that is on 1st of April, let us say that Mr. A is going to make investment of the funds. The amount of the investment is going to be made, let us say an amount of 50,000. And Mr. A is expecting that the rate of interest will fall down. So what happens at say, Mr. A is approaching Mr. B and telling to Mr. B that I want to enter into forward rate agreement with you. Let us say that the Mr. B is giving a kind of commitment that the rate of interest 12% is committed by Mr. B to Mr. A for the investment of the funds. Mr. A says okay. In a way that both of them have agreed for this. And the time period of investment is 1 year. Now, after 3 months, that is on this date, let us assume that Mr. A is finding that the State Bank of India is giving the rate of interest of 9%. Then what will happen? Let us see. Mr. A will basically make investment of this 50,000 rupees in State Bank of India. What is the rate of interest at which investment will be made? It is 9%, which is the rate of interest which is prevailing in the market. Investment is made on 1st of April and the deposit will mature after 1 year, that is 31st of March of the next year. This 50,000 rupees plus 9%. So maturity amount of deposit in State Bank of India is going to be 54,500. Now Mr. A already had entered into the forward rate agreement with Mr. B, wherein the rate of interest which was committed was 12%. In a way that we understand this 50,000 rupees should become 50,000 plus 12% should become 56,000. In a way that there is a loss to Mr. A for an amount of rupees 1,500. So what will happen? Listen carefully. On 1st of April itself, Mr. B will compensate to Mr. A. How much amount? Present value of rupees 1,500. Present value of the 1,500 is 1,500 divided by 1.09. That is the current rate of interest. So 1,500 divided by 1.09. So it comes to 1376.15. So now technically what will happen? Mr. A will have an amount of 50,000 plus 1376.15. So the total amount that Mr. A is going to invest is 51,376.15 and it will be invested at the rate of 9% and the maturity amount of the deposit will be 56,000. Let us check out 51,376.15 plus 9%, and it comes to 56,000. It means that the settlement of the forward trade agreement will be made in the present value term, that is on 1st of April itself. This is what we understand. Now let us take one more situation. Suppose on 1st of April, rate of interest of State Bank of India is 13%, for example. So now what will happen? The 50,000 rupees invested on 1st of April will have a maturity amount of the deposit after 1 year, that is on 31st of March. 50,000 plus 13%, 56,500. As per the forward trade agreement, it should be only 56,000. So Mr. A is going to receive the excess interest of rupees 500. So again the present value of the 500, Mr. A will pay to Mr. B. So we understand that over here, discounted value of the 500. 500 divided by 1.13. It comes to 442.48. So what happens, that say basically Mr. A will pay 442.48 to Mr. B right now, and only the remaining amount will be invested. So 50,000 minus 442.48, so that comes to 49,557.52. 49,557.52. This amount will be invested. What is the rate of interest? Of course, it will be 13%. So you can use a calculator, say 49,557.52 plus 13%. That is the way we will find the maturity amount of the deposit. And it comes to exactly 56,000. So this, in that say 13% interest will be added. And you will get an amount of 56,000. So if at all the rate of interest is falling down, then in that case, Mr. B will compensate to Mr. A and vice versa. We understand that say all the transaction will be executed, or all the transaction will be settled in the present value term with the difference of the interest. Again, it is considered to be OTC derivative, over the counter derivative transaction.